Thank you for joining me this Friday, the 28th of June. I'm Grady, market analyst at Bell Direct, and this is a weekly market update. The recent AI-driven rally took a stark hold this week as investors reassessed their holdings ahead of the end of FY24 and on the back of the latest inflation print released in Australia. The RBA's hawkish comments after the latest rate decision that saw the nation's cash rate held at the current rate of 4.35% were justified as Australia's inflation rebounded back to an annual rate of 4% in May from 3.6% in April, and this did top economists' expectations of a rise to 3.8%. Let's delve into what is driving inflation to remain sticky and what the impact is of the uptick in inflation and may have on the rate outlook down under. The key contributors to the significant rise in inflation to 4% in May were increases in the prices of housing, which rose 5.2%, food and non-alcoholic beverages up 3.3%, transport jumped 4.9%, and alcohol and tobacco spiked 6.7%. While some of the rises are declines on prior monthly growth, for example, food and non-alcoholic beverages rose 3.8% in April and just 3.3% in May, others like clothing and footwear and transport are on an upward trajectory over the last few months. A concern to keep in mind is the rising level of immigration down under since the borders opened post-pandemic. Between 2022 and 2023, there was an increase of 35.8% in the government's migration program, while total arrivals to Australia in April this year topped 1.6 million, an increase of 19.3% on the prior corresponding period. The increase in migration down under places further pressure on our existing housing crisis, driving up the price of property to buy and rent, and creates a sticky driver of housing inflation. Another rate hike could be considered given the latest inflation reading, which, if the RBA does increase rates, will see a likely increase in the number of defaults on existing home loans as some Aussies with higher debt levels become unable to service the loans acquired in the previously lower interest rate environment. The falling unemployment rate in Australia is another contributing factor to the hawkish outlook from the RBA toward the inflation-driven rate pathway. Australia's unemployment rate fell by 0.1% to 4% in May, with the number of Australians employed rising by around 40,000 people, while the number of unemployed fell by 9,000. A lower unemployment rate is a contributing factor to the inflation, as the more Australians that are working leads to higher spend and further increase in aggregate demand, thus presenting a case for the businesses to raise the cost of goods and therefore adding to rising inflation. In the same way, Australia's wage price index rose again in the March to May quarter by 4.1% over the year, which was the first slight ease in the rise from the peak of 4.2% in December quarter. Professional education and training and construction wages growth were the highest contributors to WPI rise in the latest quarter and post another factor for the RBA to consider in the nation's inflation journey, as higher wages means more disposable income for the spending, thus contributing to the sticky inflation rate. So where does this leave us in the rate journey, and what do investors need to consider heading into FY25? After the latest inflation print was released, the RBA rate tracker run by the ASX soared from a 0% chance of a rate rise on the 17th of June to now a 37% chance of a rate rise to 4.6% as of the 26th of June. We have seen investors acting more cautiously over recent weeks and repositioning into sectors that offer safer returns in a high interest rate environment. Consumer staple stocks have risen 6.17% over the last month, while financial stocks have jumped 4.01% as investors see the banks will benefit from the inflation drivers remaining sticky and the rate cut outlook being prolonged. A stronger gold price has also buoyed gold miners to the top of investors' buying lists over recent weeks as they provide a safer investment option to riskier growth stocks in the higher interest rate environment. Locally, from Monday to Thursday, the ASX 200 fell 0.47% as a tumble in REIT stocks weighed on the key index, and investors hit the sell button later in the week following the release of hotter than expected inflation data. The winning stocks over the 4 trading days were led by Strike Energy jumping 11.11%, West African Resources rising 6.98%, and Premier Investments rising 6.21%. On the losing end, Red 5 slipped 11.9%, 9.9%, ResMed fell 9.95%, and Deep Yellow declined 9.6% over the 4 trading days. On the broader market, the All Ords fell 0.46% this week as a 50% sell-off in luxury online fashion retail platform Setire offset Maya and Novonix rising 27% and 21% respectively. The most traded stocks by Bell Direct clients over the last trading week of June were Woodside, Westpac and BHP Group. Clients also bought into Mesoblast and Mineral Resources while taking profits from Fortescue, Drone Shield, Woolworths, Macquarie and CSL. And the most traded ETFs by Bell Direct clients this week were led by BetaShares Australian High Interest Cash ETF, Vanguard Australian Shares Index ETF and iShares S&P 500 AUD ETF. Taking a look at the first trading week of July and the new financial year from an economic standpoint, the RBA meeting minutes are out on Tuesday, which will give an insight for investors into the RBA's rate outlook from the latest meeting, which will likely change at the next meeting given the latest inflation reading. We also have Australia's trade balance out for May next week, with the expectation of continued recovery in the country's trade surplus to $6.7 billion from the $6.54 billion reported in April. Overseas next week, we will gauge further insight into China's economic recovery post-pandemic, with the Caixin manufacturing PMI for June out on Monday, with the market forecasting a continued decline to 51.2 points from 51.7 points in May. Key US jobs data is also out next week, with JOLTS job openings data for May out on Wednesday, non-farm payrolls out on Friday, and the unemployment rate for the US also out next week. And that is all for this Friday and this financial year. Have a wonderful weekend and happy investing.